Let me tell you about Ray and Carla from Phoenix. They are both 52. They've been doing everything right, maxing out their Roth IRAs every single year, $7,500 each, and they loaded those accounts up with SCHD, the Schwab US Dividend Equity ETF. Their logic made perfect sense. Tax-free dividends inside a Roth IRA? That sounds like the smartest move in the world, except it is not. SCHD is a fantastic fund, nearly $100 billion in assets, one of the most popular ETFs in America, and I'm not here to tell you to sell it. I'm here to tell you it is sitting in the wrong account, and that one quiet mistake could cost Ray and Carla over $200,000 in tax-free growth by the time they retire. In the next 15 minutes, I'm going to show you exactly why SCHD does not belong in your Roth IRA. I'll give you 4 specific ETFs that do belong there, and then I'll walk you through how to make the switch inside your Roth without paying a single penny in taxes. And the part most people miss, there's one account where SCHD actually works harder for you. I'll show you where. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. The rule nobody taught you: asset location. Most people spend all their time picking the right fund, and that matters. But here's what almost nobody talks about. Where you hold each fund matters just as much as what you hold. This concept has a name. It's called asset location, not asset allocation, location. You probably have a few different accounts: a Roth IRA, maybe a traditional IRA or 401k, maybe a regular brokerage account. Each one has different tax rules, and because of those rules, certain funds work harder in certain accounts. This is not just my opinion. Morningstar studied this. They found that for someone with $1 million portfolio, smart asset location adds an average of $112,000 to their final wealth. That's about 30 extra basis points every year without changing a single investment, just by putting each fund where it belongs. Vanguard found the same thing. Their research showed that asset location alone can add up to 60 extra basis points of extra return every year. So what makes the Roth IRA different from every other account? Your Roth grows tax-free forever. You already paid taxes on the money going in. From that moment forward, every dollar of growth is yours. No tax when it goes up, no tax on dividends, no tax when you pull it out in retirement. The Roth has one job: shelter the biggest possible gains from taxes. So logic tells us this: the investments with the highest growth potential belong in the Roth IRA, not the investments that pay the most dividends. And that's where SCHD falls short. Not because it's a bad fund, because its returns are driven heavily by income. SCHD yields about 3.2% right now. A big chunk of your total return comes as quarterly dividend payments. You're using your most powerful tax shelter to protect income instead of compounding growth. Here's the myth: tax-free dividends are the best use of your Roth IRA. Here's the truth: tax-free compounding growth is worth far more, and the math is not even close. Say you invest $7,500 a year into your Roth for 20 years. If that money sits in SCHD and grows at roughly 12% per year, which is close to its 10-year historical average, you'd end up with about $540,000. But if that same money sits in the S&P 500, which has historically returned closer to 15% per year, you'd end up with about $770,000. Same contribution, same Roth, same 20 years, $230,000 difference, just from which fund you chose. Before I showed you that number, how much did you think the gap would be? 50,000? 100? Most people don't expect it to be that large, and that's exactly why this matters. So if SCHD does not belong in your Roth, what does? Let me show you the 4 ETFs that are built for this account. The Foundation and the Growth Engine, VOO and SCHG. ETF number 1 is VOO, the Vanguard S&P 500 ETF. This is your foundation. VOO owns 500 of the biggest companies in America: Apple, Microsoft, Amazon, Nvidia, Johnson & Johnson, Visa, all in one fund. It costs 3 cents for every $100 invested per year, a 0.03% expense ratio. Here is why VOO belongs in your Roth. Its dividend yield is only about 1.1%. Nearly all of your return comes as price growth, not income. Price growth is exactly what you want compounding tax-free. $10,000 invested in VOO 10 years ago will be worth roughly $40,000 today. Inside a Roth, every dollar of that $30,000 gain belongs to you. No tax, ever. ETF number 2 is SCHG, the Schwab US Large Cap Growth ETF. This is your growth engine. Instead of owning all 500 companies, SCHG focuses on the ones growing the fastest: technology, innovation, artificial intelligence. Its expense ratio is just 4 cents per $100. And here is the number that matters most. SCHG pays a dividend yield of only 0.39%. Nearly every dollar of return is pure price appreciation, compounding tax-free, exactly what a Roth was designed for. Over the past 10 years, SCHG has returned roughly 18.7% per year. Past performance does not guarantee future results, but the logic holds. Low-dividend, growth-oriented funds maximize what your Roth does best. Are you more of a VOO investor or an SCHG investor? Some people want the broad safety of the full S&P 500. Others want to lean harder into growth. Either one works, but both belong in your Roth. 2 down, and the next ETF is going to challenge something most people believe about international investing. The Global Edge and the Tech Accelerator, VXUS and QQQM. ETF number 3 is VXUS, the Vanguard Total International Stock ETF. I already know what some of you are thinking. International stocks? Those have been terrible for years. And for a long time, that was fair. International stocks spent over a decade underperforming U.S. markets. But here's what changed. Over the past 12 months, VXUS returned about 26%. And right now, international stocks are trading at roughly 14 times earnings. U.S. stocks are closer to 22. That's a 40% valuation discount. Now, I want to be honest about something. VXUS yields about 2.6%. That's not far from SCHD. So you might be thinking, does that not contradict everything you just said? Fair question, and here's the answer. The case for VXUS in your Roth is not about low dividends. It's about growth potential. When international stocks are this undervalued compared to U.S. stocks, the upside could be significant, and you want that upside sheltered from taxes forever. One thing to know, if you hold VXUS in a taxable account, you can claim a foreign tax credit on those dividends. Inside a Roth, you lose that credit. That's a real trade-off worth understanding. VXUS gives you over 8,700 companies across developed and emerging markets: Germany, Japan, India, Brazil, South Korea, all in one fund at 5 cents per $100. ETF number 4 is QQQM. Most people haven't heard of this one. You've probably heard of QQQ, the massive NASDAQ 100 ETF. QQQM tracks the exact same index, the same 100 companies, the same performance. The only difference is cost. QQQ charges 20 cents per $100. QQQM charges 15 cents. That 5-cent gap sounds tiny, but compounded over 20 or 30 years inside a Roth IRA, it adds up to thousands of dollars staying in your pocket instead of going to fees. QQQ was built for institutional traders. QQQM was built for long-term investors like you. Its dividend yield is just 0.44%. Nearly all return is price growth, and over the past 5 years, QQQM has returned roughly 16 to 17% per year. Before I move on, I want to ask you something. Do you hold SCHD in your Roth IRA right now? Yes or no? Drop it in the comments. I read every single one, and I'm curious how many of you are about to make this switch. So now you know the 4 ETFs that belong in your Roth: VOO for the foundation, SCHG for the growth engine, VXUS for global diversification, and QQQM for the technology accelerator. But there is one more piece most people never hear about: where SCHD actually belongs and when it wins. I promised I would not trash SCHD, and I meant it. SCHD belongs in your traditional IRA or your 401k. Hold it there and the dividends compound tax-deferred. You do not pay taxes on them until you withdraw in retirement. That is a strong setup. Or consider this option most people overlook. Hold SCHD in a regular taxable brokerage account. Why? Because SCHD pays mostly qualified dividends, and qualified dividends are taxed at special low rates. 0% if your taxable income is under about $99,000 for married couples, 15% for most other filers. That is far below ordinary income tax rates. So SCHD's dividends actually get favorable treatment outside a Roth. Inside a Roth, you are using your most valuable tax shelter to protect income that would have been taxed cheaply anyway. Now here's the part I refuse to skip. Growth ETFs can drop hard. In 2022, SCHG fell about 34%. VOO dropped 18%. You know what SCHD did? It fell just 3.26%. That's a 31 percentage point difference in a single year. If you're 63 and retiring next year, that kind of protection matters more than maximizing growth. SCHD in a Roth is not always wrong. It's wrong for investors who still have 10, 15, 20 years of compounding runway ahead of them. The right fund in the wrong account is the most expensive mistake nobody talks about. If your spouse or partner manages the other retirement account in your household, they need to hear this part. The best setup is when both accounts work together. Growth in the Roth, income and stability in the traditional accounts. How to make the switch inside your Roth. Here's the best part about a Roth IRA. Everything that happens inside it is tax-free. That means you can sell SCHD inside your Roth and buy VOO or SCHG or any other ETF. 0 taxes owed, no capital gains, no income tax, nothing. You're not moving money out of the Roth, you're just changing what's inside it. Step 1, log into your Roth IRA. Step 2, sell your SCHD position. Step 3, wait 1 business day for the trade to settle. Step 4, buy your replacement ETFs. No forms to file. Now there's one trap I need to warn you about. If you also hold SCHD in a taxable brokerage account and that position is sitting at a loss, do not sell it in the taxable account and buy something similar in your Roth within 30 days. That triggers a wash sale, and under IRS Revenue Ruling 2008-5, that loss doesn't just get deferred, it disappears permanently. As long as you're making changes within your Roth, you're completely fine. No wash sale, no tax, no problems. One more thing. In 2026, you can contribute up to $7,500 to your Roth IRA. If you're 50 or older, that goes up to $8,600. If your income is above $153,000 as a single filer or $242,000 married filing jointly, the contribution limits start to phase out. Now you know why SCHD doesn't belong in your Roth. You know the 4 ETFs that do, you know where SCHD actually shines, and you know how to make the switch today without paying a penny in taxes. If someone you know has SCHD in their Roth IRA, share this video with them. It could save them 6 figures in tax-free growth over the next 20 years. Which of these 4 ETFs are you adding to your Roth first? VOO, SCHG, VXUS, or QQQM? Drop your pick in the comments. I read every single one. If you're building retirement income and want to stay ahead of changes like this, subscribe to this channel. I cover everything that protects and grows your money.